Welcome to Oanda Market Insights. The markets today in Asia have been on hold, waiting for the FOMC rate decision tonight. That's a similar pattern to what we saw in the US overnight as well, and in early Europe today. The FOMC is the one ring to rule them all as far as data happens this week. And we're all on tenterhooks waiting, mostly to see if the Federal Reserve governors adjust their dot plots. Their dot plots are these plots of future rate hike expectations. Now, the market has been getting itself all tied up in knots, expecting that the recent signs of inflation and higher yields we've seen will actually lead to those governors bringing forward those rate hike expectations. I think the market is going to be very disappointed, though, because in recent times, everybody from the chairman down on the FOMC committee has been very much emphasizing they're prepared to tolerate higher inflation in the longer end of the curve. They want it to overshoot. That's a sign of improving growth and economic recovery. And they have been saying that their emphasis is on improving the employment outlook for Americans. We have to remember that we are still 10 million Americans less employed than we were before the start of the pandemic. But I do think that even if the Fed is dovish, these expectations aren't going away, and we could potentially see another bond taper tantrum tonight as they move those expectations to the June meeting. That could mean that US yields could spike higher, and in which case I would expect to see the dollar strengthen and some quite overvalued markets possibly come under pressure, notably in the tech space. When we look at the NASDAQ chart, for example, we can see that a few weeks ago it clearly broke its March 2020 upward trend line. It has tried to regain that line a few times since, but has failed, and it really does look like it's marking time before moving lower. Looking at the S&P 500 chart, it's a very, very similar setup, and there's very much a danger there that it's going to break lower. When we look over in Asia, we're seeing similar setups in the very tech-centric South Korean and Taiwan markets, but it's really in China that things get quite interesting. When we look at the CSI 300 index, we can see here it's clearly broken to the downside. It is very tech-heavy, Alibaba, Tencent, yada, yada, yada. And we are also knowing, of course, in the news headlines that Chinese government has been cracking down on big tech, and that's been adding to the negative sentiment in China. We look at the Shanghai Composite chart, we can see a similar thing going on there as well. We have to remember that most volume on equities in China is actually from retail money. And that means that the sentiment swings very, very quickly. And usually when they run for the doors en masse, so you can get big swings. I do suspect the Chinese government has been intervening today to prop up stocks. But if Wall Street has a bad night overnight, it bodes ill for the next few days in China. I'm also looking at the dollar and gold, which have been very resilient this week, particularly gold. And if we look at the gold chart, we can see that even though yields spiked higher this week and the dollar rose this week, gold for a change did not get carried out on a stretcher. It didn't fall. And it does look like on a longer term basis that it is trying to trace out a bottoming formation between its 50% and 61.8% Fibonacci retracement levels, as it's known as the Fibonacci box. If gold manages to hold on to its gains tonight and breaks back up through the 1760 an ounce 50% retracement level, that would be quite a strong, longer-term bullish signal for gold. It may suggest that the worst has passed for gold, and perhaps gold is finally getting back its inflation hedging mojo, possibly at the expense of Bitcoin, but I wouldn't want to write that one off either. But I think of all the financial instruments and asset classes to be watching this week, good old-fashioned gold is one to keep your eye on. Thanks very much for tuning in, and we'll speak again next week.